Hi there. In this episode, we're going to talk about some important considerations as we are in the heart of tax time, getting very close to the tax filing deadline this year of April 18th. There are important considerations with respect to IRAs, Roth IRAs, SEP IRAs that you should know about so that you can put yourself in the best position going forward from a contribution perspective and setting yourself up for success in retirement. So let's dive in. As we always do in this episode, make sure you ask your questions in the comments box. At the very end, we will answer one of our viewers' questions. So first, let's talk about what is the tax filing deadline for 2022 returns. That would be April 18th this year. That's important from an IRA contribution perspective because you still have the opportunity to contribute to IRAs for the tax year 2022, assuming that you have the contribution made and you're eligible and meet the other requirements. You have the contribution made on or before April 18th. In fact, the way the Treasury regulations are written, you have the ability to postmark date the check. That is maybe your IRA application if you don't already have an account open, plus your check in an envelope postmark dated by April 18th. That will still get you in for 2022 for the previous year. So let's pause for a moment. How much can you contribute to a traditional or Roth IRA? And then we'll talk about the difference between a traditional IRA and a Roth IRA in terms of your tax return filing date. So with a traditional or Roth IRA, you can contribute for 2022 up to $6,000 when you're under the age of 50. And then there is a $1,000 catch-up provision, giving you a total of $7,000. For 2023, you can contribute up to $6,500 when you're under the age of 50, and then there's a $1,000 catch-up, giving you a total of $7,500. So if you're somebody that's 50 years of age or older, between 2022 and 2023, you're in a short window of time here, of course, right? So there's some sense of urgency, but if you play this out properly, you can have a total of $7,000 and $7,500, giving you a total of $14,500. And then there's the spousal IRA contribution. In one of our previous trainings, we talked about the spousal IRA contribution. So for a couple that's married filing jointly between 2022 and 2023, you have $14,500 going into spouse A's account and then $14,500 going into spouse B's account for a total of $29,000. And like we've talked about before, unfortunately, we find there are hundreds of thousands of Americans that aren't taking advantage of being able to maximize their contribution to their IRAs. And remember, compounding interest in the absence of taxation is powerful. So what happens here if you've already filed your tax return for 2022? Well, if you've already filed your tax return, unfortunately, you will not be able to make a contribution to a traditional IRA. You could contribute to a Roth IRA, but not a traditional IRA. Now, why is that? Because you are required to declare any contribution to a traditional IRA, to a tax-deferred account. Even if it's considered a non-deductible traditional IRA contribution, you still have to declare it on your tax return. So if you've already filed a tax return, you're not going to be able to contribute for 2022 unless you speak to your CPA or tax preparer and maybe amend your return, or there may be another way in which you can do that, but you'd want to talk to that professional. But by and large, people have already filed their return. That ship has sailed. They can't contribute to their traditional IRA. With a Roth IRA, however, like we talked about, you'd have up until April 18th. And remember, that's postmark dated. So if you have your check in the mail, postmark dated, preferably by some sort of traceable mail, and say in case it got lost, you want to make sure that you get that done as soon as possible. All right, so that's the difference between traditional and Roth as far as being able to contribute for 2022. That leads us to what's the difference between traditional and Roth. Traditional tax deferred, gross tax deferred. When you take money out, you have to pay taxes. Roth IRAs funded with after-tax dollars, grow tax-free. When you take it out, 100% tax-free, so as long as you're following all of the rules. Now, moving on to the SEP IRA. So the SEP IRA is a tax-deductible or tax-deferred account, very similar to the traditional IRA. But the SEP IRA will accept employer contributions. It actually stands for Simplified Employee Pension Plan. And you still have the ability to contribute to your SEP IRA for 2022, providing that you meet all of the requirements. Generally speaking, individuals that are self-employed, that have a substantial amount of earned income and no employees, contribute to SEP IRAs. And here's the reason why. With a SEP IRA, when you're under the age of 50 or over the age of 50, it doesn't make a difference. You can contribute for 2022 up to $61,000, not to exceed 20% of your self-employment income or 25% if you're set up on a W-2 schedule. So if you're somebody that has a substantial amount of earned income, let's say you're making $300,000, $400,000, you could get the entire amount that we referenced there, $61,000, into the SEP IRA. Remember, you just can't exceed 20% of your self-employment income or 25% if you're set up on a W-2 schedule. So if you're paying yourself, let's say $200,000, and you're paying your Medicare and Social Security and other applicable taxes, and in that case, we'll use 20%. 20% of $200,000 is $40,000. So you're contributing $40,000 to the SEP IRA. And if you're making well over $200,000, then you could potentially get upwards of the $61,000 for tax year 2022. And then for 2023, that amount goes from $61,000 to $66,000. So in theory, if you're making enough money, declaring enough earned income, then you can make your 2022 contribution $61,000 and your 2023 contribution of $66,000, giving you a total of over $120,000, and that's a tax-deferred account. Now, what's interesting is you could actually make your contribution to your SEP, and if you don't want a deduction, you can just immediately convert it over to a Roth. And then even furthermore, under the Secure Act 2.0, that legislation opened up the capability to just declare your SEP IRA contribution as an after-tax contribution. So you can just go directly into the Roth account. Now, the tax filing deadline of April 18th, I would say, yes, important for a SEP, because if you do file your return, remember, you got to make sure that contribution is in there. But with a SEP IRA, you can actually go beyond the deadline of April 18th, assuming you file an extension. Now, that's an interesting nuance with the SEP IRA that you don't get with a traditional or Roth. So with a traditional or Roth, even if you file an extension, you have to have the money in by April 18th. And I can't tell you how many folks I've talked to over the years that file an extension and they forget about their IRA contribution and they miss out on being able to contribute that money to the account. All right, that leads us to our question for this episode, which is from Mark. And Mark says, I was told I don't qualify to contribute to a traditional IRA because I have a 401k with my job. Great question, Mark. This comes up all the time. It's a common misconception, which is that we can't contribute to our traditional IRA if we are working for a company and they're offering a 401k and we're participating in it, or maybe it's a 403b or thrift savings plan or other what is known as workplace retirement plan. So when you go to the IRS website, irs.gov, you'll see it refers to this as a workplace retirement plan. The reason why I'm saying that is a common misconception is because, Mark, you can still contribute to a traditional IRA. It's just your contribution is likely going to be considered a non-deductible IRA contribution. So what's a non-deductible IRA contribution? Well, it didn't come about until 1986. So in 1986, there was a law passed. It was a tax law that was passed. And what it did is it shut off the ability for higher income earners to contribute to the workplace 401k or 403b or thrift savings plan and get a tax deduction, and then also be contributing to a traditional IRA and getting a tax deduction. Keep in mind, with a 401k or 403b, you can contribute when you're under the age of 50 up to $22,500 when you are in the year 2023, and then up to $30,000 when you're 50 and over. So the government shut off that ability to be able to recognize that large tax deduction on your 401k and then also the tax deduction on the traditional IRA. And it's dependent on your income. So if you're over a certain modified adjusted gross income, you don't qualify for a deduction to your traditional IRA contribution, hence non-deductible IRA contribution. You can still put the money in, but you're not going to get a deduction. And what happens is when you eventually take the money out after 59 and a half, the amount that was considered a non-deductible contribution is not taxed because you didn't get a deduction on the money going in. It's a non-deductible IRA contribution. When you file your tax return, and you could talk to your CPA or tax preparer about this, but generally you're going to file along with your return what's called an 8606 tax document. It's going to recognize that non-deductible IRA contribution. In short, and you can get more details in the notes section, we'll put a link for you, but in short, if in 2023, if it's your 401k with the company you work for, and let's say you're married filing jointly, if you make between $116,000 and $136,000, you're not going to qualify for a full deduction for your traditional IRA contribution. That's what's called the phase-out range. And then once you make over $136,000, you're not going to qualify for a deduction at all. And unfortunately, even if you don't have a 401k, if your spouse has a 401k, you're married filing jointly, and if you make more than, it's about $228,000, unfortunately, you're not going to qualify for a full deduction for your traditional IRA contribution. So you have to be cognizant of these MAGI limits. You can go to the IRS website. Again, in the show notes, we'll make sure to put a link so you can check that out on the IRS website. Mark, thank you so much for the question, because again, that's a common misconception that I can't contribute. It's not that you can't contribute, it's just you might not get a deduction for it. And I'll end on mentioning that what some people do with the non-deductible IRA contribution is, because it's after-tax money, they then convert it over to the Roth IRA, which opens up this whole backdoor Roth contribution. So keep in mind, you may not qualify for a direct Roth IRA contribution because you're over the MAGI limits, but you still might qualify for a contribution to a traditional and then immediately converting over to the Roth, known as the backdoor Roth contribution. We have an entirely separate training video all on the backdoor Roth contribution. Thank you so much for joining us on today's show. I also invite you to schedule a one-on-one IRA consultation with one of our self-directed IRA counselors. These are individuals that are educators that can answer your questions and provide assistance with establishing and funding your self-directed IRA. It's important to know that these aren't individuals that sell investments, securities, or solicit specific investments that may not be in your best fit. These are individuals that help educate and inform so that you can put the best foot forward for your retirement savings program. Until the next training episode, keep leveraging compounding interest in the absence of taxation. Click the link in order to register for your one-on-one consultation, and we'll see you in the next show.